So we're not going to do any intro or anything in this video because I'm going to try to keep it as short as possible and also as serious as possible because of the nature of the topic of this video. So if you guys are in any trading group chats like in Facebook or anything, I'm pretty sure you guys are aware of this article and what ended up happening. But if you guys are seeing this for the first time, what actually ended up happening this past week is that a 20-year-old took his own life because he thought he had a balance of negative $730,000 in his account. However, that actually wasn't the case, and I'll go into a little bit of details as to what exactly ended up happening from some of the stuff that is posted online from all these articles. But we can tell that he was misinformed about option derivatives is the quote that he left right before he took his own life. And what that quote or what that letter said was, how is a 20-year-old with no income able to get assigned almost $1 million worth of leverage? And once we go into details in explaining what actually happened, we're going to see that he actually didn't have $730,000 worth of leverage. He was just getting assigned on a short side position of the option, which was going to get automatically sold back to the market. Since both options didn't get assigned, that actually means that he didn't even get through the max loss of the option, so he would have still had some money left. He was never actually in debt, which is the worst part, that he took his own life without fully understanding what he had done. And I'm the reason I'm basically making this video is just in case this ever happens to any one of you guys, so you know that the balance that shows on your account isn't actually the true balance. But now we're going to go ahead and go over to option calculator and basically play out a trade that could have caused this similar scenario to a $730,000 negative balance in your account. What the individual was most likely trading was something called a credit spread. And what a credit spread is, it's a trade where you sell an option that's closer in the money than the one that you buy. So that might sound a little bit confusing, but I'm going to go ahead and show you guys exactly what that means. So we're going to be using the stock Amazon for this explanation just because it has a higher price than most stocks, and so it's going to be easier to simulate a potential trade where a balance of negative $730,000 ends up showing. So the current price of Amazon is $2,674. So we're going to go ahead here to the short option, which is the option that we're writing or selling. And we're going to go ahead and select option. And for this explanation, we're going to sell the option strike price of 2,600. So the 2,600 option right here for $14.90. So what this means is that for every option that we sell at $2,600, we would receive a total credit of $1,490. But in order to be able to take this single trade by selling this single option, we would have to have a total collateral of $260,000. So in order to minimize our collateral needed and minimize our risk, we turn this into a spread. And we're going to go ahead and buy an option right here. And for this explanation, we're going to buy the 2,500 option, which is down here. It is at $3.72 or $372. So now by buying this option and selling this option, we create what's called a spread, or more specifically a credit spread, because we're going to be receiving a credit for taking this trade. And so we would be receiving a total of $1,118 for every contract that we take of this. But in order to take a single contract of this, we would have to have a total collateral of $8,882. And the reason being is because this is our max potential risk. So the most we could potentially lose on this single trade is $8,882. So with this trade, there's three possible scenarios that could end up happening. The most optimal scenario that you would want to end up happening is that the price of Amazon at expiration ends above $2,600. If it does, that means that both of these options would expire worthless and you would receive the total credit of $1,118. So in other words, if both of these options expire worthless at expiration, you would profit $1,118. However, there's still two other scenarios that can potentially happen with this trade. The next scenario is that the price of Amazon ends below $2,500. And so if it ends below $2,500, that means that both of these options would expire in the money. And so for the short option, you would be obligated to buy 100 shares of Amazon at $2,600. You might be saying, I don't have enough money to buy 100 shares at $2,600. That would be $260,000. However, you don't need to worry, because since this option also expired in the money, you can exercise this option, which means you have the right to sell 100 shares of Amazon at $2,500. So your broker does this automatically. You don't have to do anything, but both of these options would get exercised, and if that happens, you would be left with the maximal risk of $8,882. And so that would be the end of that story. You just move on with its loss. However, the third scenario, and which is most likely what ended up happening with the individual, is that the price of Amazon ended somewhere between $2,600 and $2,500. So let's say the price is at $2,590. So you're still left with the obligation to buy these shares at $2,600. So if you go ahead and take out the calculator and do that trade, $2,600 times 100, and we multiply that, and we're going to turn this into negative times -1. Just so it's clear. So this would be what would actually show up on our balance on our portfolio. And the reason why it would show up as negative is because we don't have the capital to take this trade. However, the current price of Amazon, as I mentioned, was at $2,590. So that means we could sell them back right away at $2,590. So we do this plus 2,590 times 1,000, because we're selling back 100 shares, and we're going to see we're left with a total balance of negative $1,000. So the reason why it showed up as negative $260,000 at first is because the funds from the 2,590 didn't settle yet, and it usually takes about like 1 day to settle. So it would show up as negative $260,000 for at least a day, because they usually settle throughout the weekend. So if we take a look, we'd only lose $1,000 on this trade, and if we remember, our maximal loss was actually close to $9,000. See, $8,882. So we wouldn't even lose our max loss on this trade. We would actually still be left with about $7,000. So let's do the scenario that happened to the individual. So let's say we go back and instead of only taking one contract, because all the math that we did was with one contract. So let's say now we took 3 contracts. So now our total credit and everything would be multiplied by 3. And so let's say that the price still ended at $2,590. So that means that this one would still be in the money. And so we'd still have to buy 100 shares at this price. However, since now we have 3 contracts, instead of showing up as $260,000, now it'd be $260,000 times 3, because we're selling 3 contracts. And so now we'd be left with a total loss of $780,000 showing up on our account, because remember, we have to sell these shares. And so if we do this times -1, just to make it easier to understand, we see that this would actually be the balance that shows up on our account. So I can understand why you might be worried if this shows up on your account. I personally would be worried, but I have a little bit better understanding. So I know that even though it shows as negative $780,000, the other options still have to settle, and so that would cancel out the majority of this loss. And so what I mean by that is, so let's say that the price was still at $2,590. So we do this times 100, but in order to get up to that, we would actually have to multiply by 3, remember, because we're taking 3 contracts now. And so we put equal to that, see, we'd be left with $777,000. However, we sold the option at $780,000, so we have to subtract that. So we do this minus $780,000. So we put equal, and see we left with a total loss of negative $3,000. And so it's still considerably less than the loss of negative $780,000. But as you can see, what the individual in the situation didn't know is that the options from the $777,000 hadn't settled, and so that's why he thought that he had lost negative $780,000. It's an honest mistake if that can happen if you don't know how options work. So that is why I truly believe that before you start trading options or anything in the stock market in general, you have a full understanding of what you are doing, because if not, you can get in certain situations that you might not understand, and they might be misleading, especially in this case because the options hadn't settled. I don't like pointing fingers, but in this situation, the person that was at fault here was both Robinhood and individual. But if I'd have to say more, I think it was the individual, just because he was trading something that he didn't fully understand. But the reason why I also say that Robinhood was at fault is because most brokers won't show the negative $780,000 balance. They just take care of it, and they have algorithms in their systems to just show the actual loss of negative $3,000. For some reason, Robinhood doesn't have those algorithms, so it shows as negative $780,000 until these options from this one settle, and then it's going to show the negative $3,000. So if Robinhood would change this, it'd be a lot better. It would save people some headaches. But that doesn't mean that you should still be trading this if you don't understand. Like, if you didn't understand anything that I just said in this video, you probably shouldn't be trading options, because like I said, you're going to be getting into scenarios where you probably don't understand what it is that you're doing, and it could potentially lead to bigger losses, or just situations where you don't understand what you're doing. But that's pretty much it for this video. I hope you guys enjoyed. I'll be back to posting my weekly trade recaps in the next video. I just wanted to make this video to, if you guys ever get in a situation like this, you have a better understanding and you don't end up like the individual in the video. My thoughts go out to his family and everything, because this is definitely a sad situation, especially considering that the individual wasn't in debt by $780,000. He was actually more in debt. Like, he actually wasn't in debt because he didn't take the max loss. But that's all I have to say for this video. I hope you guys enjoyed. I will see you guys in the next one.